And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's Wednesday. That means it's the hump day edition of the show. Of course, already plowing through the middle of the month, the middle of the week. Thank goodness, Thanksgiving next week, right? Just right around the corner. Have you been cutting back your calories, Brent? Getting ready for the big feast?
Oh, I've been fasting.
You've been fasting, yeah.
Yes.
So, yep, can't wait. So, it's the one day of the year where diet's out the window. Yeah, baby. So, yeah, it's gonna be it's just on elbow room and extra utensils.
It's gonna be epic.
Exactly. So, all right. Well, I hope you have a good Thanksgiving. So, a few things kind of wrapping up this week. Of course, Friday is options expiration day. We've got record number of options out there right now. So again, we haven't had a lot of volatility in the market as of late. It's been very quiet. Ever since we kind of got the sell signal on the markets, we really haven't gone anywhere. Markets have just kind of been consolidating sideways here about over the last week. That's good news, actually. As long as this market can just kind of go sideways, it's a way to kind of work off this overbought condition. Sell signals are still in place currently, but again, that just suggests that prices really don't have to go anywhere. It doesn't mean you have to have a big correction. So again, looking for an opportunity here as we get past Thanksgiving and get into the month of December. Potentially, we're going to see an opportunity for that Santa Claus rally. So kind of want to get positioned for that. Be a little bit cautious here the first 2 weeks of December, as we've talked about before. That's mutual fund distributions coming up. Let me just say this one more time. I said this the other day, and I always get a tremendous number of emails and phone calls of people in panic right in the first couple of weeks of December. They'll call me up and say, I don't understand why my mutual fund just declined by 1% today. Just all of a sudden, it just went down 1% or whatever it is. Well, that's the distribution. And what's going to happen is that you're going to see a sharp drop in your mutual fund. And this only applies to mutual funds. This doesn't apply to ETFs or individual stocks. But you'll see it in mutual funds. So if you own mutual funds, your 401k plan, IRA, etc., you're going to see a drop. And that drop is when that fund makes its distribution. Now, don't panic over this. This is just the normal process. You'll see the price drop when they make that distribution. In a couple of days, you will either receive your shares of the new fund if you're doing dividend reinvesting, or you'll have a cash deposit if you're having everything paid out in cash to you. You'll have a cash deposit in your account, and your account will rebalance. So don't freak out over the big declines that will come up in mutual funds. So it's a 1-2 day event. It'll be over with. Mutual funds reside. And interestingly enough, I have one person that calls me every year. It's the same person. We have the same conversation every year. So and they're not even a client. They're just a friend. So anyway, yeah, we don't use mutual funds, so I don't have to worry about this. Anyway, a couple other things this morning. It's always interesting when you hear on the media about fact checkers and about the spread of misinformation. Well, talk about the spread of misinformation. This morning I'm driving in, listening to work, and of course, Janet Yellen now talking about the fact that December the 15th, now we were expecting December the 3rd was going to be kind of the runoff date for the Treasury to be able to pay its bills. It's now moved out to December the 15th, so it gave us a couple of extra weeks here. But coming in this morning is like, well, Janet Yellen says that she's got till December the 15th to avoid the first ever default on U.S. Treasury debt. That is not true. We have defaulted on our debt previously, several times actually throughout history. They were technical defaults, but they were defaults nonetheless. And that's all this would be as well. If we fail to raise the debt ceiling, could we default on our debt? Yes, we may have a technical default. What is a default on debt? Debt default is simply the failure to make the interest payment. Doesn't mean that you didn't, and it could mean also not repayment of principal, but in this case, it would be the failure to make a timely interest payment on the debt, right? That would be a technical default. As soon as the funding bill was passed, the debt ceiling was raised, we would then make that payment within a couple of days or whatever. So yes, there would be a technical default on the debt. It would not be terrible. It would not be the end of the world. And yes, it has happened before. We have done this before, and the world didn't end. And it won't this time either. We will get the debt ceiling raised. There will be, a increase in the spending, and the Treasury will ultimately have their money to go out and pay the interest on the debt. It will get done. People will still get their paychecks. Social Security checks will still go out. Military benefits will still go out. The whole 9 yards. It'll all still happen. So again, we've been here before. Nothing to worry about. Nothing to panic about. So when you hear this stuff in the media where people are, running around waving their hands with their hair on fire, talking about the end of the world because if we don't raise the debt ceiling and spend more money, we're going to default on our debt. Just remember, it'll get done, and it's happened before. So, and we're still here, amazingly enough. Another thing, another piece of misnomer. The bill is paid for, right? This $1.2 trillion of spending for infrastructure is paid for, and the Build Back Better plan is going to be somehow magically paid for. No, it is not paid for. If it was paid for, let me just provide you a very simple analysis. Every time that we pass a bill of spending, right? Every time there's a spending bill that's passed, and this has been going on for 50 years, by the way. Every time we pass a spending bill, everybody touts, they go, the CBO says they score it, and the CBO leaves out a whole lot of things and then on the scoring, and then they also use unrealistic inflation rates, unrealistic interest rates, etc., and never account for a recession whatsoever. So, but if the CBO was even close to being correct and every bill that was passed was paid for, we would not have a $2.5 trillion deficit. Think about it. We would also not be spending over 100% of our revenues just covering social welfare in terms of Social Security, Medicare, Medicaid, prescription drug benefits, and interest on the debt. That's the mandatory spending. That now requires more than 100% of the income that comes in just to cover those costs. And we're going to add more to that, by the way, when we start doing, more social spending for paid medical leave and all these other things. And of course, any type of program that you start that is a give me to the economy is never sunsetted. It becomes permanent. So what will happen with a CBO score? They'll say, well, the Build Back Better plan is paid for if all these programs end in 2 years. They won't. If you add this up and keep these running out over the course of the next decade, as they will do if it's passed, we're talking about a $5 trillion roughly spending bill. This is going to massively increase debt and inflation, and it is not paid for. So again, none of these things are paid for, right? This $1.2 trillion infrastructure bill, it's paid for. No, it's not. It's $550 billion of new spending. The remaining $700 billion was spending that we did that wasn't used for COVID, but that's still all issued on debt. And guess what? That wasn't paid for either. So none of this is paid for. It all comes down to taxpayers. And of course, in the Build Back Better plan is, of course, the reinstatement of the SALT deduction, which is where states that do not have a state income tax subsidize the taxes of states that do. And of course, for Californians, this new increased amount of the SALT deduction to $72,000 is going to be a big benefit to the Democratic constituents in California, because they will vastly benefit from this. And of course, the state of Texas, which does not have a state income tax, will happily subsidize those Californians for their SALT tax. So there you go. It's all the use of your tax dollars and where they go. When they come back after the break, we'll get a little bit into the markets. We did Candid Coffee this past weekend. That video on the website now. If you missed out, we talked about the markets for next year. We have some questions that we're going to get into that we didn't get to cover there with Danny Ratliff. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Hi, Lance Roberts Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome to any day now. What's going on, Brett?
I'm busy over here.
Doing something. There's lots of new buttons to push with all your new toys. Real quick here before we get it, Danny Ratliff joining us this morning. Good morning, Danny. How are you? We had Candid Coffee this past weekend, and I joined Danny and Richard to talk a little bit about the market outlook for 2021. 2021. The outlook for 21 is if you listen to our video, we said that the market would be up 25% and 20 for 2021 meant the market outlook for 2022.
And you're busting me for getting distracted.
I know. I've got ADD this morning.
It's all right.
My daughter,
Yeah?
she has got ADD to no end. We're in the car the other day, and she switched topics like 15 times in a minute. So, poor thing. She's smart as a whip, but just can't focus. I don't know if she's really got ADD or if it's just, she's a kid.
Sounds like she comes by it naturally.
She's a teenager.
Yeah.
Right?
Just a curious mind.
Could be a curious mind. Because my dad always said that about me growing up as well. But back then, it wasn't. We didn't have ADD when I was growing up. That didn't exist. It's just pay attention, boy. Smack upside the head. Focus. Pay attention to what you're doing. Get your head out of the clouds. Now everything's got a name now.
Yeah.
Real quick, we're gonna put. So we had this Candy Coffee over the weekend. That video is actually on the website, realinvestmentadvice.com. If you go there, it's right there on the homepage, and you can, watch that conversation that I had with Danny, with Richard, talking about the markets for next year. Well, and we were taking questions during this event, and we had a few questions that we didn't actually get to. So we're going to go through some of those questions this morning. But real quick, I want to clear up one thing, because I always get emails about that statement that I made at the open, talking about the SALT deduction and how states that don't have an income tax, a state income tax, subsidize states that do. And I then always get this email, I don't understand how that works. Well, the SALT deduction, which is the state and local income tax deduction. So if I live in California and I pay state income tax, when I file my federal taxes, I get a rebate for those state and local taxes. Right? So the government has to send those dollars out. So in Texas, we don't have a state income tax. So we don't get that benefit of being able to get a refund on our state and local taxes, which means that the tax dollars that Texans pay that go to the government, that we don't get a rebate from or a deduction for, go to the government, who then turns around and sends them to the state of California. So that's $72,000 a person that individuals will get in California for their state and local income tax deduction will be paid for courtesy of red states that don't have a state income tax, like Florida, like Texas, like others. So that's what I mean by subsidizing. That money comes from somewhere. It just doesn't magically appear out of Peter Pan's left pocket. Okay? Why are you laughing, Danny?
No, great analogy. You've been full of them last couple of days.
I've been full of something the last couple of days. I'm not sure if it's painkillers or just sarcasm.
All right.
I'm so jealous of you, Danny. I went and tore up my right knee just so I could be you.
Yeah.
I look up to you. So, I want to be like Mike. So I went and tore up my knee just so I could join you. How's your knee doing?
I could have thought of a lot of things you could have done better than that.
Look, my wife says that a lot.
Yeah.
There's a lot of things I can do better. So glad you're back in the studio. We've missed you.
It's been good.
Nice to have you here live.
Yeah, good to be back.
Absolutely.
Get out of the house.
Yeah. I can only imagine.
Those walls were closing in pretty quick.
So, but you're healing up. You're walking around good.
I'm getting there.
Nice.
Not quite where I need to be, but slowly but surely.
Absolutely. All right. Well, a couple of things to get into here. You've got some questions that we didn't quite get to in our event last Saturday, and I thought we could just go through some of those and answer those questions, and then we've got some other topics to get into as well. But I just thought we'd touch on those first. Yeah.
So first and foremost, Candid Coffee has been an event that we created essentially to answer questions, right? Especially during COVID where people weren't able to come in. It was one of those environments where we thought, you know what, let's just open it up for just general questions, have no preset or pre-formatted agenda. And so it's become really popular in the sense that kind of like office hours, so to speak. And it's been good because we get so many good questions. It gives us a lot of great content. And really, it's also good to make sure that we understand what concerns you. And so, dealing with people each and every day and the moving parts within finance, it's really important. And so we got to a lot of questions, Lance, and a lot of them are really good. I may want to circle back on one or two of those as well, just to elaborate a little bit, because even afterwards we were getting questions like, hey, this was really good. You mentioned you can go find it on realinvestmentadvice.com, go to YouTube channel, The Real Investment Show. So go check that out. Lots of great content from Lance and from Rich with year-end planning tips. But, some of the things or concerns are taxes, right? Planning. What are we going to do right now? We've seen, it seems like everything's been scaled down quite a bit. The infrastructure bill was scaled back. This bill scaled back. What's the likelihood in your eyes right now that you see we're going to see higher taxes this year, retroactive, or will it be something that'll be potentially pushed back to 2022 if the Democrats can't control both the House and the Senate?
So that's an interesting question because last night I was emceeing a mergers and acquisition kind of event. So there's about 70, 80 people at this event. They're all bankers and investment bankers and business owners, people that want to do M&A type stuff. And it was interesting because the entire conversation revolved around higher taxes. Everything kept coming back to, well, if tax rates go up, and right now there's a massive surge. We're basically pushing record levels of M&A. And the whole time that I'm listening to this conversation that's going on, I'm going, the last time that I heard all these same stats was in 2007, right? Just before the Fed started hiking interest rates, just before, all these things. But, it was, very exuberant in the room. Boy, if you want to get a deal done, this is the time to do it. There's just money. There is literally money laying on streets. If you want to do an M&A deal, there's somebody willing to throw money at you regardless of what you're doing. Very interesting conversation. But it all kept revolving around taxes, but yet we haven't had any new taxes, right? There hasn't been a repeal of the Trump tax cuts. Now, we do have, and Danny, you can elaborate on this, but we do have some of the Trump tax cuts are going to sunset. I'm not sure exactly what the dates are, but those sunsets on some of those taxes are coming up here in the next couple of years. But right now, there's not been any new taxes. There's lots of worry about new taxes, but we haven't seen any new tax rates coming. And the problem for the Democrats, of course, now is that if they want to try to pass a bill and they need bipartisan support at all for any reason, they can't hike taxes, right? Because the Republicans won't go along with new tax hikes. And it's interesting to listen to Joe Biden talk about the new infrastructure bill that just passed. He's like, any American with that doesn't have over $400,000 will have no taxes. related to this bill? Well, there's no tax on people with over 400,000 either. So why are you throwing that number out? But the second thing is that this also reminds me of George Bush back right after the Reagan administration and his line that sank him ultimately in his reelection, which is read my lips, no new taxes, right? And this sounds very much similar to that. This is, taxes always go up. And when taxes do go up for any reason, especially in this type of environment where you want to pay for multi-trillion dollars of spending, they go up on everybody. It's not just people over 400,000 and everybody else gets away with it. That's not the way tax hikes ever work. The problem going into the next couple of months, and one of the things that the markets are really kind of ignoring right now, is this debt ceiling issue, right? So Democrats have to raise the debt ceiling. They're losing support even internally inside of their own party for the Build Back Better plan. They've already got pushback from Joe Manchin and Sinema as well on this plan because, look, more spending is going to create more inflation, and inflation is a problem. And Senator Manchin was just on television, I think last night, talking about, hey, I just went to the gas pump and people are upset about what they're paying for gas. Yeah, they're upset for what they're paying for gas because prices are going up. Retail sales yesterday up 1.7%. Those are nominal. So while the media was running around yesterday going, retail sales are strong, the consumer's back. No, that's inflation. People aren't buying more stuff, right? We don't measure it in the volume or quantity of things bought. We measure it in dollar value. People are paying a lot more at the pump for gas, right? You're paying $60 for a tank of gas versus $40. That's $20 extra in spending. I'm making up numbers, but you get the point. That's additional spending. That's why retail sales are going up. So these are already taxes on individuals. Inflation is a tax on individuals. Inflation impacts everyone, and it impacts those at the bottom 20% that spend 80 to 90% of their income on essentials, even more than everybody else. So taxes are already going up. But I don't think, and again, I could be wrong. I think the Democrats are going to have a real tough time trying to raise taxes to any great magnitude. We talked about Elon Musk for president on Monday. Because of his selling stock to pay his capital gains tax, and the fact that I think if they try to pass a capital gains tax and CEOs start selling their stock in mass and the market's down 20 or 30%, Democrats lose an election, right? So I think they've got a real tough time going into, and especially with midterms right around the corner, as a long-winded answer to say that I'm not sure they're going to get much passed here.
Yeah, well, I think it's already a skeleton of what it once was. So we know that it's going to look a lot different from what the original bill, this summer looked like. And, we keep having these dates that they say, hey, this is it. We have to have it done by this date. We pushed it back from, September. They issued a new bill September 13th. Then it was, October 1st, October 31st. Now here we are on the 17th of November and no bill.
We're going to have a vote next week, though.
Of course, like every week.
Yeah.
Every week.
Yeah, I'm not sure we will. Again, look, I could be wrong. They could try to shove something through. They may get it through the House. I think the Senate's going to be the real problem.
Yeah.
Again, who knows? Anything is possible. But, I think this next couple of months is going to be very difficult. And with what's going on with the coming midterms and what's happening with some of these elections, I think the Democrats are getting really worried about re-election potential. Be right back after the break with Danny Ratliff. More questions coming up. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife put up Christmas lights this weekend, so she's very excited now. But she's very upset at the same time, Brent.
Why is this?
She ordered another Christmas tree for the house. Showed up at the house, she set it up, she goes, honey, this tree's not big enough. We need another one. We'll have one on one side of the fireplace and one on the other. And I'm like, no, we're not. One tree.
The Real Investment Show podcast. Same show, your schedule.
Needless to say, I slept on the couch this weekend
at realinvestmentadvice.com.
The saga of Christmas trees in my household.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. I'm your host, Lance Roberts. Of course, it is Wednesday. Thanksgiving's next week. Can't wait. We were talking about that earlier. You got plans? You in town? You going hunting?
No, I'm in town. In-laws are coming in.
Yay.
It'll be great.
Oh, you get along with your in-laws. Gotcha. Okay.
Yeah.
No, I'm teasing. Actually, I like my in-laws, which is a good thing, right?
Yeah.
So,
for sure. It makes a big difference.
It does make a big difference. So we were just talking a few minutes ago about, kind of some of the questions from our Candied Coffee event we had this past weekend. So if you're just tuning in, go to the website, realinvestmentadvice.com, and this past weekend, we did our Candied Coffee event. It's our outlook for next year. And we basically talked a lot about markets and what to expect next year. And we took a lot of questions. And we had so many questions coming in that we didn't have a chance to get to all of them. So we're playing a little bit of catch up today on those questions as well. So what was the next question on the list?
Well, I want to tie up some loose ends on that last one from a tax perspective. So you mentioned, when does the Trump tax code sunset?
Right.
And so essentially that's 2026. So the end of 2025, you step into 2026, they revert back to those Obama era taxes. So we will see some changes if they do nothing at all, which they very well could, and just say, hey, we're going to wait, do nothing, and essentially we're not going to be the bad guy. Mm-hmm. And taxes will go up automatically. But can they wait with all this new stimulus, all the money that they've thrown out? That's the $1 million question. Well, $1 trillion question, right?
Yeah, $1 trillion question.
So Lance, we talked a little bit about the first segment. You talked about the infrastructure bill, some of the things that are in it, what that means. A handful of questions around that. Where should someone invest? Is it too late? Is it are there areas that are primed to do very well in the future?
Well, so that's a two-part question.
Yep.
So first part is that infrastructure is never as shovel-ready as people think it is, right? And initially what happens is, and this happened back in 2008 when Barack Obama passed the $800 billion infrastructure bill. What we found out a couple years later is that most of these jobs weren't as shovel ready. We were building bridges to nowhere and doing other kinds of stuff. So, but initially stocks are going to respond to this idea that, oh, there's going to be all this spending, right? We're going to spend $1 trillion and it's going to be great. Well, two things to remember. First of all is that, the spending is over a very long period of time. So it's not really a massive impact to earnings. It's not going to show up on the balance sheet and income statements of these companies immediately. Qualcomm's up, an extra $400 million because of broadband build out. That's not going to happen that way. This is going to be spread out. It gets diluted. It really doesn't impact corporate earnings that much. But again, market psychology and reality, two different things in the short term, and these things are already starting to move. Companies like Deere and Caterpillar on the heavy equipment construction side is benefiting. Qualcomm, who provides chips for 5G broadband build out, that's been running up sharply here over the course of the last few days. There's probably more room to go. These stocks are very overbought, though, so you need to wait for a little bit of a correctional, kind of pullback here. I think we'll get one in the next couple of weeks. We'll see. But try to just measure, where you're chasing positions. There's some companies that haven't moved that may actually benefit from this build out longer term. Verizon, AT&T is a good example. They, provide a lot of the bandwidth, for 5G. Verizon, one of the leaders in the providing of broadband internet. So, that company really hasn't moved that much yet. I'm not saying go out and buy it. We just, full disclosure, we own it in our portfolio already. But, there are companies that, get an initial pop because that's where speculative money is chasing. And then there's more fundamentally driven companies that may actually benefit well over the longer term. But of course, you think about, which companies are going to benefit the most. Well, companies that are going to be providing either materials or equipment or labor for the build out of these infrastructure projects. So, everything from cement to iron to contractors to equipment for building roads and bridges on the 5G side, everything from the chips to the copper to everything else needed to build out internet. That's just kind of start thinking about in those directions. There's ETFs that actually already cover the entire spectrum. So if you're just looking to buy a basket of stocks that participate in these infrastructure supported projects, there's ETFs for that as well. So again, just think about, it's kind of the old saying about, do I want to buy the gold? And this is, one thing when gold was going up, there was a big saying out there for a while. It's like, don't worry about buying gold, buy the guys providing the picks and the shovels. Kind of the same thing for infrastructure. Don't worry about the broad issue. Find the guys that are providing the picks and the shovels for these infrastructure projects. And again, it's not as beneficial to economic growth as everybody makes it out to be because it's so spread out over time. And again, these projects, it takes a very long time to get through all the red tape, to get them approved. And in a lot of cases, they never get approved and the money never gets spent. So, always kind of keep that in the back of your mind is that this is a slow drip, not a fast impulse of cash.
Or it gets spent, but not in the right places that's actually productive.
Well, I wasn't going to say anything about fraud and waste, but, and by the way, Sheriff Joe, why do we have a president that nicknames himself? I don't understand this. But anyway, Sheriff Joe says he's going to be on top of this spending to make sure that he's going to personally oversee the spending to make sure that none of it is fraud and waste. He can't remember which bill he was talking about, but he's going to make sure there's no fraud and waste in this bill. And he's now named himself Sheriff Joe on this issue. So.
Excellent. I wonder which bright one that came up with that idea. Hey, we're going to start nicknaming ourselves.
Yeah. Well, most presidents nickname other people.
Yeah.
But he nicknames himself. So.
Hey, it's great. Great to watch. So,
by the way, my new nickname is Sheriff Bob. So there you go.
Sheriff Bob.
Sheriff Bob.
Okay.
All right.
And what are you policing?
I don't know.
Okay.
The next question, that's what I'm policing.
Fantastic. So talk a little about infrastructure, places to invest. What about the year-end push? We're concerned with, you talked a little bit just a bit ago about distributions here year-end and mutual funds, money managers will have to make. Where do you think they'll go? Historically, people have pushed money into Apple. They pushed into some of these tech companies because they felt like there's no other alternative to some extent.
And it's still the case.
Yeah. So you think that's going to still be the case in the future with these distributions and where they put funds back to work?
Yeah. Couple of things there. First of all, is that we talked last week about money flows have been coming out of technology. And actually, we've seen a good bit of money transferring out of tech into other areas over the course of the last couple of months. So over the last week, we've seen that begin to reverse, and technology stocks are now outperforming the S&P as a whole. So we're already starting to see that transition back into technology, and it kind of makes some sense in a way because, you're moving into Christmas, so people buying, iPhones and Macs and these type of things. You kind of see the point. But part of this has also been driven by Tesla because of the move in Tesla. That's been part of it. The problem is right now is that the FANG stocks, the kind of the top 5, 6, 7, 8 stocks in the index, which now includes Tesla, by the way, now make up 30% of the entire index. So pretty much, if you want to just beat the market or you want to participate with the market, just buy the top 10 stocks of the index, right? That's what's going up and that's what keeps going up. Where money's going to go to, they're going to go back into these stocks for a couple of reasons. One, there is no volume in the market. This rally we've had in the market over the last few days has been on declining volume. It's been exceptionally weak, and that's what we call a lack of liquidity. There's buyers out there willing to buy stuff at this point, but if anybody shows up in mass to sell, there's no buyers willing to buy at these prices. What will happen is you'll have a very sharp decline in the markets when selling actually begins to happen in earnest. And that's why when we do have sell-offs, we see these things pop up when markets are down 1.5% or 2% in a day. That's because there's no buyers there. That's that lack of liquidity. So for fund managers and portfolio managers, us, we need areas that we can get into and out of very quickly without really having to suffer a big price decline. In other words, there's always a steady supply of buyers, and that's in those top 6, or really kind of top 10 tech stocks in particular, because they're highly liquid. And once you start to get down into the mid-tier of the S&P, or particularly at the lower tier of the S&P, that liquidity dries up very dramatically, and the ability to get out of a stock very quickly becomes very difficult. So to your point, I think that we could see a little bit of selling pressure first couple of weeks of December, as we usually do. That's not a guarantee, by the way. That's just historically speaking, statistically speaking, when distributions occur, particularly in a fairly illiquid market, probably we'll see some declines. That'll set us up for that end of year portfolio window dressing, and that's what's called the Santa Claus rally. And that last really kind of week of December, as portfolio managers, hedge funds, mutual funds get ready to report for the end of the year, and they send out their quarterly statements to everybody. They need to make sure they own all the stocks that were big performers this year, so they'll put those on their books right at the end of the quarter, and that leads to this kind of Santa Claus rally that everybody talks about. So again, I think you see a bit of a decline first couple of weeks of December, rally into the end of the year, and then next year all bets are off.
Yeah. So we keep hearing this sentiment on, for quite some time, in fact, about international stocks. So the next question we get back from the break is going to be a little bit about, are they actually cheap? And I know you and Mike have ran analysis after analysis on this. And when's going to be the time to invest? I mean, we've seen how hard they got hit during COVID, all those fun things.
All right, look at that. That's actually a good question. We'll talk about international emerging markets when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. Hanging out here with Danny Ratliff this morning, catching up on our Candied Coffee event that we had this past Saturday. That video is on the website. If you go to realinvestmentadvice.com, right there at the top of the page are all of our videos, and you'll see one for Candid Coffee, and that is the replay event from this past weekend where we were discussing our market outlook for 2022. And we're kind of catching up on some of the questions we didn't get to during that event. So again, go by the website and click on that event link and enjoy that video there. And of course, picking up some questions here. We left off talking about international and emerging markets. International and emerging markets have not performed well this year relative to the S&P. Now, again, this is always very important, and you have to be careful about analysis. So the question is basically, if you listen to a lot of media analysts right now, there's a lot of conversation talking about how international emerging markets are cheap relative to the U.S. Now, that's where you got to be careful. They may be cheap relative to the U.S., but valuations are not. We don't compare valuations in the U.S. saying, oh, U.S. stocks are cheap relative to Europe, right? We just say, look, stock valuations in the U.S. are 40 times earnings, second highest level on record, market cap to GDP, 2.5 times economic growth. That's expensive, right? That's how we look at the U.S. We don't compare it to other countries. So when you're going to buy emerging markets, China, India, Russia, whatever, you can't look at their valuation of their stocks relative to the U.S. because their economies are different. You have to look at their valuations relative to their economies, and their stocks are expensive. Importantly about emerging markets, inflation is a problem. As inflation goes up, the cost of goods being purchased by individuals gets more expensive, and consumers have to consume less. Emerging markets are dependent upon exports for their income. Their economic growth comes from what they export. Primarily, the emerging markets are primarily exporters to other countries, industrialized international as well as the U.S. So you have to look at these factors relative to these countries. Now, am I saying you shouldn't own international and emerging markets? For us, that answer is right now is no, I wouldn't. And we don't own international and emerging markets in our portfolios because they have been underperforming the S&P. Now, this is where we start talking about asset allocation.
And of course, Wall Street has been driving a narrative that you should just buy and hold an allocated basket of goods and you'll be fine. Just kind of ride the markets up and down. Don't worry about it, because it's good for Wall Street. It's not necessarily good for you, but it's good for Wall Street, because if you're just buying a bunch of stuff that they provide you, they're getting a fee on it and you're just suffering the returns. But over the last 12 years, international and emerging markets have been a boat anchor on the performance of your portfolio. If you take a look, just simply do the math, do the work yourself. Go pull up a chart, go to stockcharts.com, pull up an S&P 500 chart on stock charts, and then overlay a chart of international and a chart of emerging markets going back to 2009. And what you will see is a massive underperformance. So if you had those equally weighted in your portfolio, your S&P has done well, international emerging markets not so much, so your overall return is lower than just being invested domestically. And that's why we don't own it, because we're looking to maximize our performance with the least amount of risk possible. Having said that, underperforming assets in 1 year tend to eventually outperform in another year. The question is when. Last year we talked about nobody wanted to own energy stocks last year. Last year energy stocks were the death, right? Oh, I can't believe you own energy stocks. They're terrible. They're all going out of business. This year they're the best performing asset class, not by a little, by a massive amount. So that's generally the case, is that, one thing to be looking for is opportunistic investing, where asset classes or countries or whatever have been beaten down to a great degree and have underperformed. But again, you can't just say, oh, it's been underperforming, so now it'll outperform. It doesn't always work that way. Right now, there may be some tradable opportunities in international emerging markets next year. But again, it may be a very short-lived transition depending on inflation. And as we talked about before on the show, if the U.S. gets a cold because of inflation, because of the Fed hiking rates, because of lack of spending, whatever it is, if we get a cold, everybody else gets a flu, because all these other countries, China, emerging markets in general, are all dependent on the U.S. to sell their products. We are the consumer for all these other countries. So if we get a cold, they get the flu, which means those stocks will underperform. So we're very late in this cycle, and the most important thing right now is about, rather than trying to speculate and chase returns, wait for these markets to tell you what's opportunistic, invest opportunistically, and beware of the risk.
Yeah, and large cap value international, just in general, everybody's been saying, hey, this is such a great buy because it is so cheap. But like you mentioned, it's cheap for a reason.
Yeah.
I mean, I think I've heard that same question, that same story since like 2015.
Yeah.
So it's been some time.
Every year.
Yeah.
Every year it's the same way. It's cheap.
Exactly. So, talk about green energy a little bit. We've seen this huge, massive run up in green energy. Mm-hmm. In our portfolio here, we own some lithium stocks, Albemarle, full disclosure,
right.
LIT, ETF. What about other areas, uranium, other places? Is this a bubble that we're seeing right now? Is there potential for quite a bit of a pullback, or are these investments that are just going to keep on running?
Well, we always think that something is going to keep on running forever once it starts running, and,
Yep.
and that's the whole idea. Those things never occur. You always get a correction because there's going to be a point where reality kind of collides with the fantasy. Mm-hmm. Tesla is a great example of this. I mean, Tesla is an awesome company. I don't have any problem with it, but the function of Tesla cannot be valued at more than every other automaker combined, which it is right now. They are, regardless of what you want to call them, you can call them a pink elephant, but Tesla is an automaker. And eventually it will succumb to the dynamics of the automaking market at whatever point that happens. But same idea with green energy. Green energy is not efficient. It is not, ecologically sound, and it's not environmentally clean. And no matter what form you want to look at, whether it's wind power, solar power, electric vehicles, these are not climate friendly productions because they require either a massive amount of mining
deforestation, or they require an immense amount of petroleum product to build those units, right? So, this is going to be the reality, is that the inefficiency of these issues is going to start to push capital back towards petroleum and ultimately coal. In fact, we're already starting to see the coal movement now. So if I was going to be an investor, I would probably be starting to look back towards coal as a potential viable tradable opportunity, not necessarily today, but something I'm watching close on the radar, because as people realize that green energy is not as efficient as coal and oil for producing energy, especially when it comes to warming your house, driving your car, and more importantly, keeping your lights on, that's where I think we'll see a shift of capital. Look, the green energy revolution is here. That's not going away. This is going to be a thing. But valuations, the speculation in these industries are exceedingly overdone. And when there's look, we saw this with solar a while back when we started initially talking about the transition to solar energy. These solar stocks took off and they had huge runs, and it was going to be the next coming of the world of investing. Then they all crashed, and they crashed huge. Now they're starting to come back here a little bit. A good example is go take a look at a company like Plug Power or Ballard Power. These stocks had huge runs when they first IPO'd. They thought this was the new transition. They crashed, and some of them are still trading at exceedingly low valuations. So, we're going to go through this bust and bubble type of cycle in green energy, and it's fine. But just understand that you're not paying for the new technology. Tesla is not a technology company; they're an auto company. They will ultimately succumb to the dynamics of the auto market. And as you get more and more of these companies that are providing green energy, climate change type solutions, that will dilute opportunity within the markets, and eventually fundamentals will creep up with the fantasy. And when those two collide, it will not be pretty for stock prices. Again, this is just a function of how markets work. So enjoy the ride for now. Just understand that what goes parabolic in one direction tends to go parabolic in the other direction at some point. So,
well, a lot of this could be political subsidies, just like you mentioned, solar power. That's the Obama administration's their big push. Same thing we're seeing here. Now, the green energy has certainly been here. But what about when we get this volatility? Now we see this big dichotomy on what happens. Do we go to gold? Is that the safe place, or is it crypto?
Well, that's the what is it today? That is the $60,540 question on Bitcoin. Because gold, we've been watching gold very closely in our office because of the, normally when you're having running rates of inflation and negative real rates, which we have right now. In fact, I just did a chart for an article I've got coming out next week. We now have negative 6% savings rates on money market accounts, which the only other time that has occurred is at the late in 1978 during the oil crisis embargo, when we had 15% inflation. So because rates were so low going into this problem to start with, we now have the same negative dynamics on savings that we had during the massive inflation push, in the late 70s. So gold should be $3,000 an ounce right now. It's not, and in fact, there's not really much of a demand for gold in terms of market demand at the moment, because people are so involved in speculating in asset. But why would I own gold when stocks are going up, 25% a year? That doesn't make any sense. Why would I want to own gold when, Bitcoin's gone up 100% since its lows earlier this year? It's all about this speculative drive in the markets. Ultimately, that breaks, and I think gold becomes a really great buying opportunity. It's just not today.
Yeah. Makes me kind of want to go buy some gold.
Kind of makes you do.
Yeah.
All right, that wraps up the show today. Danny, thanks so much. Glad you're back.
Yes, sir. Good to be here.
It's going to be a regular deal. You coming back?
It is.
All right, awesome. Be sure by the website, Candid Coffee. It's on the website now, right on the homepage, realinvestmentadvice.com. Download, you basically click on that video link and watch our Candid Coffee event, our outlook for 2021. We cover a lot of ground in that 1 hour on that video. It's on the website now, realinvestmentadvice.com. Of course, send myself or Danny any questions you have. We're always happy to help you out. Realinvestmentadvice.com. Just right there at the top is a form you can fill out. Ask any question you want. We'll answer it for you. Make sure you're taken care of. And, of course, while you're there, check out all of our blog posts, our newsletter. Make sure you're registered for our weekly newsletter as well, and get our daily commentary. It comes out every morning before the market. Realinvestmentadvice.com. See you tomorrow.